Welcome back to the Money Gains podcast. Today, we're going to unpack exactly what is going on in the stock market with a very good friend of mine, Rich. Rich, welcome back to the show, man.
Great to be back, Sammy. How are you?
Mate, I'm great. We had a lot of fun on Friday as well. I was on your show.
That's right. Yeah, we welcomed you on to the TV show in the early morning. Thank you for getting up a little bit earlier than you're used to.
That was a lot.
Yeah.
Yeah, no, just because of the day I had before. I was in the studio all day and I didn't get home till late, and then I was up with a 5 a.m. wake up, and I should have probably.
Shame.
I know.
I can hear the violins out there already.
They're singing. They're singing from the rooftops.
But yeah, you were good. It's almost like you'd done it before.
It was weird being on the other side.
What was it like live rather than edited by the great Danielle?
Yeah. Danielle makes me look way better. I've not watched it back yet though, so
we've already done 3 cuts in this episode already. I don't know if anyone can tell.
Yeah, so you wouldn't know. Yeah, there you go. But for those that don't know you, little 411 into your history and why you're very well placed to be able to have this conversation that we're going to have today.
Yeah, so I guess my first love was 400 meter hurdling. I was an athlete. I did the Commonwealth Games back in 2002, showing my age. But I really wanted to get into the stock market after that. So I joined Credit Suisse. My first day work experience at Credit Suisse was the day before 9/11, and had the startling realization of a kind of welcome to the real world, watching the second plane go into the Twin Towers on the trading floor, and the subsequent gasps and panic that ensued. And then that was the first kind of intro into how wild things can get. And then joined Credit Suisse on the graduate scheme, was there for 3 years, then moved to a hedge fund called Brevin Howard. Now, Brevin were the second biggest hedge fund in Europe. What I didn't know that was about to happen the following year was the start of the great financial crisis. And what a place to be to experience that, because we had such great economists, great thinkers, and great traders and portfolio managers. So to experience, I was there for 3 years, right through to 2010. And to experience that with those guys was, it was a very bonding moment, because everybody's going through it together. But I had a lot of friends at Lehman's, spoke to them the days before it happened, and they still believed in Dick Fould and said, no, we're fine, we're going to be fine. So I think coming out of that was a real feeling like you'd almost done a PhD in finance. So then I went to run the emerging markets department at Credit Suisse. So that was equities, South Africa, Turkey, Russia. So then I moved from finance to also geopolitics. And you got that real kind of feel for macro, for interest rates, for currencies. And from 2020, I decided to do my own thing and got into teaching. So I now teach investing. I do the morning show, Trade Live with IG, and also now a podcast, The Art of Investing, which is teaching people it's not all about the S&P 500 and your all world trackers. There are alternatives, Sammy.
Well, we're going to talk about a few of those today, but some other bits as well. And I think it's really interesting because you are so well, you've seen the world, you've seen some of the biggest moments. You were on the floors, you were trading real money, trying to keep your clients afloat during some of the most craziest times in history. And then equally as well, you've spent nearly 2 decades in this, you get this. And so it was super interesting because last time we were on, if anybody wants to go back and watch that, we were on the show in February the 26th. February the 28th was the all-time high in the S&P 500. Yeah. And we had at the time, that's since been beaten. However, you predicted a 30% drop in the S&P 500 at that time. Now, a few days later, we were messaging back and forth because we were like, is this it? Is this it? And that didn't actually happen until April. So we were a little bit off, but there was a small decline throughout that period. Eventually, we were 23% off. So not bad.
Yeah. Yeah. And it's funny, you kind of, you pull these numbers out of somewhere. So the 30%, I was happy with at the time, but I must admit I was starting to buy at down 20%. And starting to go in to a point where I remember that Sunday evening, waking up, seeing the futures down again on the Monday morning. And that was a really interesting, because I had to go in and do the TV show. And of course, you've got your own positions, you've got your own investments, but you understand that the audience out there is really hurting. Like, it was a proper crash on that Friday stroke Sunday night, Monday. So, we got it. We were a little bit early, but it's better to give people a chance to take some of their holdings down rather than be late to it.
Yeah, but if you look at it, we weren't early as such because it had some meteoric rises. It was due a correction of some sort at that point.
Yeah.
And we just didn't know how big it was going to be, but it was so overvalued at that point that it was only a matter of time. So what was the big catalyst?
The big catalyst then, well, I mean, it was, we were overbought, right? That was the February the 28th catalyst. And we started getting into problems around interest rates, concern about the jobs market. But of course, it was the tariffs of April 11th that were really devastating.
Liberation Day.
Liberation. He certainly liberated people of their savings,
and
their investments. I remember watching it at home, and the Goldman Sachs put out straight away that it was only a 10% tariff across the board, and the market popped 50 points, the S&P 500. And they got it wrong. That was something else. There was a baseline 10%. And of course, at that point, you already sold into it, because as soon as he got his silly board up with all the numbers written on it, it's like, oh, what is going on here? There were some 60s and 50s on there. Like, this is not good.
And it was like China ended up being like in the over 100% at one point.
Yeah. And we've obviously come to know the term tackle. Trump always chickens out. So isn't finance wonderful? Isn't it so incredible that you can watch things unfold in front of you and you can express a view? If you didn't believe Trump, if you thought he was bluffing, you could express that view through buying or selling volatility, or whatever way that you wanted to, selling the dollar. If you really don't believe that what he's doing is good for America longer term, you can bet against the dollar. And that's what a lot of people have done by buying gold. And of course, gold has probably been the best investment since we were last on.
I've definitely got a question about that today, because we spoke about that the last time, and it's just since gone like meteoric. But I'm going to come back to that, because there was quite a pivotal moment where things started to turn around, which is generally usually what happens with a crash. They say that the 30 best performing stock market days, I think it's something like don't quote me on this, but a large portion of them come immediately after the drop, and that's what happened, right?
That's right. And we were really lucky on the program that morning. A couple of things had happened the night before. And I said to my co-presenter, this is it. This is the day either he has to backtrack or we're in serious trouble. And we managed to put a trade on that day, which had 100 times payoff.
Wow.
It was an options trade for the market to be up 6%.
6.
And in the end, I think it was up 6.5%.
Yeah.
And it paid 100 times payoff, and a few of the viewers actually put it on, and it was magical. Just to get that kind of one every now and again is
100 times isn't bad.
100. I took money at 50 times,
okay.
So
okay.
I chickened out myself.
Yeah, well, I think anyone would. You start seeing those types of returns, and you're like, well, you might take some off the table. But since then, we've kind of had what could be only described as a massive bounce back, and then some aggressive increases in returns over that time. Earnings in the tech sector keep breaking records. We've seen huge earnings again this year across the board. There are, again, some chatter around AI and bubbles that it's creating within the tech sector, but equally as well across the market. What's your views on that right now, and how are you feeling?
Well, it was interesting. So BBC did a spread about it at the weekend. The Times, it was on the front of their business section, is AI a bubble? And I got a phone call on Saturday night, can you come on LBC with Matthew Wright tomorrow morning?
Oh, cool.
Is AI the bubble about to burst? And if everybody's asking the question, truth is it's probably not. But I've got a term for you today.
Okay.
Do you know what we're in at the moment? Now, everybody's heard of irrational exuberance. Do you know where that was from?
No.
First coined by Alan Greenspan
Okay.
back in 1997.
Yeah.
Before, he was talking about the market was going through this exuberance and it was irrational. Okay. So he was basically predicting the dot-com boom 3 years before it happened. Way too early, right? But nobody really knows what a UK chancellor called the 1929 Wall Street boom before it crashed. And that was an orgy of speculation. And Sammy, we are going through one of the biggest orgies that you will ever see in financial markets.
This is new to me.
We've got NASDAQ all-time highs, the AI stocks going crazy, right? We've got gold, astronomical, silver. We had Bitcoin at the highs last week, Ethereum. We've got even treasuries are rallying. House prices are at highs. You can't have that. You can't have it all together like that. It's too easy. And when it's too easy, we know what happens next.
We do. There's an argument as well of like a lot of once interest rates come down, then these guys aren't getting the same rates from their savings accounts and their bonds. And so do they then put their capital in and that drives a rally even further?
Yeah, well, there's also a reversal of that though, because there's a chance that interest rate policy is actually impotent.
Yes.
Right. And because it hasn't worked, the Fed tried to stop inflation through increasing interest rates, and nobody can believe that it hasn't actually slowed the economy. Unemployment rate should be 5% by now, right? Now, maybe we're in a point where the wealthiest 10% of the American population are, how would you say, responsible for 50% of the consumption.
Yep.
Okay.
Which would make sense.
Now that is, well, it was only 25% 10 years ago. So we've seen this huge explosion of the wealth and the wealth gap is extending. And that means the wealthy don't necessarily have debt, right? So that means that what they're actually been enjoying, they've been enjoying additional income on their savings that didn't happen back when interest rates were at zero. And when interest rates were at zero, we were dating a girl called Tina, right? Now we're dating a girl called Tara.
Okay.
Okay, we've moved. And this isn't anything to do with the orgy of speculation.
Okay,
Sammy.
I was wondering if yeah.
So Tina means there is no alternative.
Okay.
Interest rates were zero, right? That means you could only really invest in stocks. And that's when everybody did. And everybody got used to this S&P 500 tracker. Boom, every month. There you go. However, now Tara is looking a lot more attractive. There are real alternatives. That is real alternatives. Because interest rates up to 4.5%. You've got, some corporate bonds are paying 7%, which is decent. And I'm talking about corporate bonds of real companies, the likes of Heathrow Airport, you could get a decent return on. UK corporate bonds that are sort of household names. But there's also alternatives from other stock markets across the world. It's not all about the S&P 500. And when you see, your question was originally, are we in an AI bubble? Some of the valuations that we're on at the moment. So, and when I say valuation, I'm talking about what multiple of this year's profits does it cost to buy a share of the company? Okay, so you can think about that in terms of years, maybe.
Yeah.
So at the moment, it'll take me 30 years for Microsoft to pay me my money back, right? Now, I'll still have shares at the end of it. And of course, everybody wants to grow profits, but there is a small chance, especially with the likes of NVIDIA, that you're at something called peak margins, which could be peak profits, which means that the multiple should reflect that. And you shouldn't be paying peak multiples at the moment. Now, that's what we're doing for the S&P 500. We're paying 24 times, right? 24 years worth of this year's earnings to buy the S&P 500 at the moment.
When it comes to investing, choosing a stocks and shares ISA for me is one of the most important steps you can make, and it comes down to three things. What can I invest into? Are they trusted by their customers? And most importantly, how low are their fees? So after testing over 10 different providers, I have landed on Trading 212. They have an excellent mobile app with thousands of stocks and funds available, and they offer commission-free trading with zero platform fees. Plus, they're fully FCA regulated and have FSCS protection up to the value of £85,000. And right now, they're offering listeners of this podcast a free share worth up to £100 when you deposit just £1 into your account. So if you're looking for a low-cost stocks and shares ISA to start investing, it's hard to look anywhere else other than Trading 212. Use the code MGP for Money Gains Podcast to grab your free share today. We broke that down on the first one. So like if you put the pound in today, it's got to multiply by 24 times essentially to be that same pound, right?
Exactly. Yeah. If you were making £1 of earnings,
Yeah,
then you're paying 24 times that to buy a share of those earnings today. So
yes,
you're paying a share price of £24. Exactly. Now for the FTSE 100, you're only paying 15 times, right? Now it doesn't have the AI bubble stocks.
less sexy.
Much less sexy, right? If you go into an orgy of speculation in the FTSE, then, you know, it's not that great.
I mean, it'd be quite nice, wouldn't it, in the UK to have something like that for once, but we're very old money corporate. These are global corporations, but they've been around for donkeys and they move slow.
They move slow. And then you look at maybe the small caps in the UK. Can Rachel Reeves come out with some incredible policies in this budget that actually make UK small caps attractive? Because this is their second longest period of underperformance.
It is.
In 40 years.
It is. But Andrew Craig came on and spoke about this in 1952 to 1997, I believe. It was 16% plus per year. And so like they're crying out for cash injections. So, I mean, it would be incredible if he did that. He had the idea.
And I loved his idea.
It's cool, isn't it?
Genius.
The £5,000 per child, and it just goes into small cap and small and medium. I think it'd be a very cool move to like basically stimulate a stock market and an economy, which is struggling.
Andrew Craig for Chancellor.
I would vote.
I would.
Would you
Definitely.
vote? Yeah. We'll tell him that.
Yeah.
He'll like that one.
He'll be listening.
Yeah. You know what? I don't know if he would do it. And I wish he did. And the comments on that video are literally like hundreds are like, why is this guy not Chancellor? And I'm like, he just sees it logically, which is fantastic. But yeah, going back to this, it's like there is opportunities in other areas, right?
There are, because you asked me, is AI a bubble? And AI might actually not be a bubble, because we know it is absolutely huge. But what we have got is a CapEx bubble, right? And we've got 4 bubbles going on at the moment.
And what's the CapEx for an everyday person?
Capital expenditure. So that's when you build factories and you build things for the long term as part of those big investment plans into growth in the future.
So investment into your business for growth. Yeah.
Exactly.
Okay.
And so obviously to build a data center and to pack it out with all these incredible high performance chips, that's CapEx.
Did you see the OpenAI?
This is what I was coming round to.
That blew my mind.
Yeah.
And the investment from the other companies.
So I've got another term for you, if you don't mind. Is this an 18 rated podcast?
It is now.
It's going to be by the end of this. So they're on a circular jerk. And that is what is going on with this. By all means, cut that out if you like.
No,
but you cannot have a company paying... Okay, so sorry, NVIDIA has paid OpenAI $100 billion to take a stake in OpenAI. OpenAI then has promised to use that $100 billion and more to buy NVIDIA chips. Subsequently, they have then done a deal with AMD, which is along the same kind of lines, that they'll take a 10% stake in they've got the option to take a 10% take in AMD. And then just before we came in here, they announced another one with Broadcom. They've got a partnership now with Broadcom, hot off the press.
You're kidding. Oh, wow.
Broadcom's up 8%.
And that's to build a data center when their revenues and this investment doesn't even cover that, right? As well as what I was reading.
Yeah, they've got no cash.
They've got no cash, and they've got to build all this money. And so the money's coming from these companies to fund this data center with their chips. And that's the circular jerk.
Where they now have obligations of $1.2 trillion.
That was the number that I'm glad you said it. It's just... it's mind-blowing.
And these are the red flags, right? There are 3 red flags recently that have just made me sit back and go, all right, it's time to reduce risk.
Mm-hmm.
It's not time to take leverage, right? Because, of course, leverage exacerbates your gains, right? That's when you get the real money gains, Sammy. But it also exacerbates your losses on the downside. And that's what I want people to avoid at the moment.
Let's just quickly discuss one point you said there, because we have a lot of beginners which listen to this. So leverage as a real small example. Let's say you buy £100 of Apple stock and you leverage it by 5 times. What happens in that?
It's a mortgage.
Yeah.
Whenever you buy a house, you're leveraging up.
Mm-hmm.
Right. If you use a mortgage, probably unlike yourself. So, if I put down a deposit of £50,000 in a house, and then I get £450,000 loan to buy the house that costs 500,000, then I've leveraged 9 to 1, 10 to 1. So that you can also do that in stocks. So you put down that deposit, but you get maybe 5 times the size of the position.
And it's wild, right? It can go very well or very wrong.
It can go very wrong indeed. And banks do it, but there are strict regulations. And you would hope that some hedge fund managers have got experience enough to know when to be careful, but sometimes not.
And if it drops, it can liquidate your position and some.
That's right.
Yeah.
Yeah, and you're wiped out. So you don't just lose 10% of your capital, you lose all your capital. Now, there are times when this can be a good thing, right? You've definitely got to be experienced, and you've got to be beyond a beginner investor to do that kind of thing. Mm-hmm. But there are times when it can be really, really useful, right? And the subsequent from April 11th was exactly that opportunity. That you see things and you know that it's just a panic. And as soon as he backtracked, then that's the kind of time. Usually it's when volatility has gone up through 25 and it's maybe trading at 35 or 40, right? So that's the VIX index, if you want to Google it. The VIX index is a measure of how scared we all are. Mm-hmm. So if it's gone whoosh all the way up to 40, everybody's really scared at that moment, and the market's moving by 2.5% a day on average. If it starts to come down and you've got subsequent good news, then that's the kind of time that you've got some real opportunities. Doesn't come around very often, but COVID was one of them.
Yeah.
As soon as the central bank said, we'll do whatever it takes, that was one of them.
Oh God, that was such a good year.
Incredible opportunities.
Such a good year, man.
But at these points when everybody's already made the money, and it's so easy to make money right now, Sammy. I mean, it's incredible. You look at your pension and you probably can't believe what number it says. Well, I'll give you a drill to do, a little fire test.
Okay.
I came out of my apartment the other day, and there's a sixth form college just down the road, and it's boarding. And the poor beggars, 5:45 in the morning, they were all lined up, and the fire alarm was going off. And so I saw one of the teachers. I said, "Oh, is everything okay? Is there a fire alarm?" She went, "Oh no, we're just doing a drill." 5:45, get a bunch of students out of bed. I thought that was harsh, but we're going to do a fire drill right now, Sammy.
I was laughing because that actually happened to me once. But
oh, really?
I did board for a bit, and I remember it well. Like 4 a.m. they did it to us, I think.
Ooh.
Yeah, it was like middle of the night territory stuff. Yeah,
was anyone caught in any interesting situations?
No, I was 10, so it was a bit different.
Eating sweets under the duvet.
Yeah.
So yeah, the fire drill is write down everything you have invested in at the moment, right? And you're going to have 3 categories: low risk, medium risk, high risk. Now, low risk, what's in that? It's the defensive stocks, right? So if you own tobaccos, utilities, telcos, or maybe the alcohol beverages, right? And water companies, Tesco, stuff like that. If you own that stuff, that goes into low category. Medium category is S&P 500. It is the Nikkei, Japanese Nikkei. Anything that generally isn't sex, drugs, rock and roll. And then we go on to the high risk stuff, which is your AI names. It's your Nvidia, Palantirs,
Your Teslas.
Oh, well, that's in a different chart. And crypto, right? And I want you to apply a discount to each of them. So I want you to check what would happen if we do have some kind of correction / crash. Now, we talked about 30% last time, so let's stick with that. Because if we drop 30% here, that's back down to where we were on April the 11th. So we're going back 6 months.
Yeah, I was just about to say, it's not a huge, like if you look back from then, even on that date, many would argue even at that point that the S&P 500's valuations were still very high.
It's just not unimaginable. By no means, I'm not sitting here this time saying I think it's going to drop 30% because I don't think that. But I do think we're due a correction.
We are due a correction.
Yeah.
For sure. And whether that comes by the time this podcast comes out on Wednesday or if it's in a few weeks' time, it's only a matter of time.
Well, 54 days was our last
54 days was our last one, but corrections are now happening on average. It was 1.26 years. It's now down to 1.18. So that's 10% or more, and 20% or more is 3.2 years. So it's just a natural part of the cycle and actually very healthy. But you mentioned something, I don't want to skirt around it, because you mentioned about leverage, and leverage is a big risk at the moment. So you wouldn't be taking on risk right now in this environment. What did you mean by that? Just so we can finish and round off that point.
Yes, certainly.
And then you're going to give us your prediction.
Okay, so you're greedy now. So if I can invest, let's take an ISA, for example, right? And let's say somebody has £60,000 in their ISA. You can invest £60,000, right? Now, that's fine. There's no leverage involved there. However, there's a new product in the US and it's become really, really popular. And this is one of the red flags. It's leveraged ETFs. And so you can buy £10,000 of Nvidia, but it actually gives you exposure to the moves on £30,000 of Nvidia. So it's a 3 times leverage. Now, again, these things, they're here to stay, right? So there's no point in arguing the morals or should they even be available. But that means that if the stock move, if you invest £10,000 in one of these things and the stock goes down 10%, you've lost 30% of your money. So that's what's easily available at the moment, is these leveraged ETFs.
And they're very attractive because people look at that, especially when they're at £60,000 and they think, well, if I do this right, I could be a millionaire in 4 years.
Yeah.
One
day, Del Boy.
Oh, I did it at the beginning. So I remember these well, because you could leverage hard on these platforms back in the day.
Right.
And I remember thinking, well, like Microsoft, sure thing. But then you end up paying rent on the actual leverage itself.
That's right.
Which is really dangerous, because then you're like, well, hang on a sec, why am I down? It's gone up by 2%. Again, you're like, what? Oh, okay, there's rent on this. And so you've got to be very sure.
And guess who makes money from it?
What, the banks?
Of course.
Yeah. So that's why they do it, right? But if you get it right, it can be brilliant, but it's very difficult.
It's very difficult. Avoid any volatility product, right, from banks.
Right now, this is right now.
No, I'd never trade a volatility product in an ETF form.
Brilliant.
It's just a guaranteed loser.
Okay.
And the banks are the only one that make money from it.
Good.
And I speak from experience. 2018 got all wiped out.
Okay.
because the market was down 7% in a day.
Rich has been there. Got the t-shirt.
Oh hell yeah! But I live to stop other people experiencing that pain, especially as I was sitting in Medellin, Colombia at the time, having a wonderful holiday, and that really ruined it. And it was Jerome Powell and Donald Trump, and the market had gone higher and higher and higher, 30 basis points a day, every day. Now that reminds me a lot of the last month.
Yeah. So the Buffett indicator is a nice tool.
Sorry, let's just finish. So the low risk, medium risk, high risk, we've got those three buckets.
Sorry, our thing.
You're going to haircut the low risk by 10%, right? You're going to take 20% off the medium risk total. So you've taken all the money that you've got invested and you divided it into those three: low risk, medium risk, high risk. You take the number, take 10% off your low, 20% off your medium, and take 30% off your stocks like Nvidia, Palantir, because those stocks can go down 30% in a blink. That would take 4 days. And then add the three together and just see how that number looks compared with what you've got at the moment. Now, my ISA and SIP together are at all-time highs as of this day today, right? So they're now all in cash, apart from one stock, Pinsana, which is a rare earth miner. And because Trump and Z are fighting over rare earths, I thought, okay, I'll have some rare earth miners down in Angola. So I've got Pinsana, but that's the only thing I own. The rest is in cash because I'm really happy with that number for the year. It's more than I thought I would ever have with this year. And I do not like the thought of losing 10%, 20%, or 30% of it, trying to realistically make 10% more. Because I think a drop comes before that extra 10%.
Yeah.
And if that number scares you, it's time to reduce the risk. If you don't like what you see, if you take 20% off the total, let's say, if that hurts to see your wealth go down by that much, it's time to reduce risk because it can happen.
So let's talk about this then. If you've gone all cash, I know we spoke about this quite heavily on Friday, and some people, that's difficult for them to even fathom doing, even though like, especially for the guys that are just like set up my ISA and park into indexes, and like I just do that for ages. So if you're worried at the moment and you're hearing things like this, or you're seeing stuff in the news, and how does someone like physically assess? Let's say I'm a total beginner, Rich, and like all I do is occasionally like check in on my stocks and shares portfolio.
Yeah.
How do I begin to even assess whether an index or a certain index or something along those lines is overvalued or undervalued? We mentioned the VIX. Yeah, that's not the sole way of doing it, right?
There's two ways. So you can look at valuations. Valuations, we talked about PE ratios. We touched on that. So I don't want to kind of hammer that home too much. But we are at 24 times earnings, and we've already priced in. Okay, so the market already expects 12% earnings growth next year. So there can't be any disappointment because that's in the price already. So now the normal average is 18 times earnings, a PE ratio of 18 times for the S&P 500. You'll come back and say, we've got an AI revolution coming on, Rich, come on. Now, to finish your point there, we do have an AI revolution, and that's going to take over the world, and there's incredible things happening, but it doesn't mean that it'll happen in the current form that it's in.
Yes, exactly.
It's unsustainable. We cannot use that much energy on, you producing a meme to send to me of, a funny joke.
No one wants to see the inside of our WhatsApp chat, Rich. But it's true. Yeah, you're right. They're using vast amounts of energy, and the investment in this area is going to be it's unsustainable at these levels. But there is no doubt it's going to change the world. It's just how.
If you moan about Taylor Swift taking a private jet, 160 miles?
Yeah.
There's no way you should be using ChatGPT, because trust me, you are wasting much more than she did.
Yeah. It's just not seen because it's in a wire.
No. So that's the second one of the bubbles. The first bubble is the CapEx, that everybody's building the data centers and the chips.
It's fashionable.
It is. It's definitely. It's the only way. You've got to spend 600 billion, and Mark Zuckerberg, in fact, made up the number.
He did, and also you see China coming out and doing it for a tenth of the cost, and everyone doesn't even look at that, and they go, "Oh no, this is the way it needs to be done."
Yeah.
But actually, it doesn't. And there's going to be a pretty, for me anyway, from what I've read into this, is that it's there's going to be a pretty eye-opening thing when. It's kind of likened to when they build like those supermarkets and then they're just empty. That's what it feels like. It's going to end up being like you build all this infrastructure and eventually it'll be powered by this tiny thing like that, because technology is going to allow you to get to that point,
which is super efficient, and you're going to be sitting with empty data centers.
Exactly.
So the idea at the moment is you need to go down the nuclear energy to power the data centers. That's the second bubble at the moment. So if you're in Rolls-Royce, just be careful. You've had an incredible investment, much better than me. My ex-girlfriend and I think one of your pods was about relationships and difficult money chats. Mm-hmm. She would throw in front of me the fact that she had bought Rheinmetall, which was the German tank producer, and Rolls-Royce, and she had made 10x on both of them. And, so that was too hard for me to stomach, clearly.
Fair enough. I get it.
But yeah, nuclear energy is the second bubble. The third bubble is quantum computing. And then the fourth bubble, I'm not 100% on this one, but potentially robotics. Because I just interviewed a robot on Friday after I interviewed you. I'm not going to say which was the more interesting interview.
But that's an interesting one, because it could flip. Right, that could be in your homes, and Tesla builds armies of these robots, and it's actually really very valuable, right?
Yeah,
and
1 billion robots coming to us.
Yeah, I read that too. It's mental, isn't it? Can you imagine? I'm actually right with it though.
Yeah. And this thing, we had an arm wrestle, and I won, so I'm still okay with this.
Did you?
It's called COID, so it's the Crane Shares Humanoid ETF, and it's just been launched in the UK. This robot rang the opening bell of the London Stock Exchange on Friday morning.
Jokes. That's brilliant.
It's brilliant, but it's also potentially a short-term top, if we get into that kind of thing. Now, it's a great ETF, and I'm sure I will invest in it at some point. But the four bubbles are CapEx on AI, nuclear power, quantum computing, most definitely. I'm actually short Rigetti. And then robotics. So that's your orgy of speculation. So
running a business is a juggling act. And when it comes to managing my money, I run all of my 3 businesses through Tide. But one of the smartest money moves that I've made is setting aside my business savings, especially for my tax pot. Tide's Instant Saver account offers up to 4% AER. What I like about Tide is how simple it is to use. You don't have to bank with Tide to open a savings account either. And you don't need a big deposit. You can get started with just £1. If you fund your account with £5,000 in the first 30 days, you'll receive £100 cashback. And that's a great incentive for saving smarter. There's even a calculator on Tide's website, which helps you forecast your interest, perfect for keeping track of your business finances. And yes, it's FSCS protected up to the value of £85,000, so your savings are safe as well. New members receive up to 4% AER for the first 6 months. For the full T's and C's, visit tide.co/savings rate. Check it out via my link in the show notes below, and don't forget to use my promo code GAINS to unlock your cashback offer. Okay, so we've got that right now. So in your opinion, if you were to put a number on it, where do you think we're going to end up in, let's say, the next time this happens? So the correction, if and when it happens, or the crash if we get to that point?
Do you know, it could be a correction sideways.
Interesting.
There's and that's at an index level, because we started the podcast, The Art of Investing, and the sole purpose of this is to educate the nation on how to invest. Now, you mentioned beginners, and the ones that have just opened an ISA or a SIP, and they don't really know, they're just learning what an ETF is. So we go through, what's an ETF? How do you describe equities? That's the second episode. Third is on commodities. The fourth is on kind of everything else, right? Bitcoin bonds, and currencies.
Just proper dive into assets.
A deep dive into a beginner's guide.
Brilliant.
And then we launched the model portfolio in week 7. And so this is taking, and we do it all in percentages, there's no money. We do, how would I break down my asset allocation if I had X in my ISA? And it's not just me. If you're already bored of hearing my stories, then luckily I just host it, because I've found two guys that are way more experienced than I am and way more knowledgeable than I am. One of them worked for Soros hedge fund, sat next to George Soros, and George used to phone his house to ask him advice. So that's how qualified this guy is. And his name's Chris Fellingham. And you're just incredible man, 40 years, but he's also pretty damn funny. So it's real fun to have him on board.
Yeah.
And then the other one is Mark Spice. His middle name is, his nickname, was Spice.
Love it.
Right, Mark Spice Holden. And Spice was head of investment at Standard Life.
Cool.
Another 40 years. So the thing our selling point is, between us, we've had 100 years in the market running money.
Nice.
So we've taken this model portfolio, and I'll tell you how it looks at the moment. And this is my thing, that if we're in these bubbles, they're pretty much all in America, right? You don't have too much of a bubble in the UK. You definitely don't have a bubble in the Nikkei in Japan. You don't have a bubble in India. So we've broken down, and we've still got 20% in America. So between the S&P, NASDAQ, and Russell 2000. Russell 2000 is more like the small caps across there. We got 20% there. We've got 10% in the good old FTSE. We got 10% in the Nikkei. And of course, that's had a great week recently, because you've got a new prime minister there that's very open to growth. We've got 10% in global mining stocks, right?
Yeah.
And that's because
the Anglos, Americans, etc. Yeah.
Exactly.
Yeah.
Anglos, Rio Tinto, BHP, Freeport, McMoran. And that's because resources are becoming more sought after, especially copper and gold. There's 30% of the exposure there is
funny that copper and wires, data centers, etc. So you're seeing the spillover from that.
Spillover, it goes into everything. So we got 10% of these global mining fund. We've got 10% in the DAX. Looking back, that's our mistake. Maybe shouldn't have gone.
What's the DAX for?
German DAX.
German DAX?
Yeah.
Yeah.
The equities there. And then we've got 5% in something which is...
That's a lot for the DAX.
It is a lot for the DAX. And it was in week 7, and it was when we were seeing the questions around American exceptionalism.
Yeah, okay.
And money was flowing into the DAX. I think we all admit that was our mistake, but we don't want to cut it yet. Then we've had this thing called the VanEck blockchain and crypto ETF.
Yeah, I know it well.
It's up 51% in the 8 weeks since we bought it.
That does not surprise me. Yeah.
That sometimes it's good to have these things, because you realize I wouldn't have actually known that if I hadn't been part of this podcast. That to me, as soon as it goes parabolic like that, then that's the end of the rally. And that's why I'm talking about these corrections.
Yeah.
So we've actually sold half of that.
Have you? Interesting. You took profit. Yeah.
Took profit only on half. The guys won't let me sell.
Technically, it's ending up like 7-8% of your total allocation at that point. So it needs a haircut. Yeah. To stay in line.
Exactly. We've got 5% in India, in the MSCI India ETF.
Oh, I love that, baby.
Yeah. It's such a strong part.
Yeah.
And then, but so this all changes week by week, episode by episode. We do a weekly episode, and it's just exciting. So, but the main takeaway is we've got 20% in cash, right? And we're earning 4% on that uninvested cash.
That's the thing for us right now, I think, is what is the game changer. We spoke about this on Friday. I think you asked me what my biggest game changer is, and I was like, the fact that we like brands like IG, Trading 212, whoever you do decide to use for your ISA, majority of them do interest on uninvested cash,
Huge.
which is just enormous because it takes the pressure off. It's not sitting there making zero anymore. It's getting money sometimes better than what your savings account will give you, which is just brilliant.
Yeah. And there's offers now and again as well for signing up. You know, maybe you get a higher interest rate for a few months, that kind of thing.
Yeah.
Or free shares. I've noticed some of them do that as well.
Yeah.
So it's cash is a decision in itself, right? And that's what the guys have really rammed home in those first few episodes. You know, you decide to buy gold, you decide to buy the FTSE. Oh, sorry, 5% in gold as well. You decide to buy these things, but you've got to think of cash like, I am deciding to hold cash. What's my return? What's the upside? What's the downside? And we've decided at the moment markets are so elevated that we're actually going to sit 20% in cash, which is huge.
It's enormous.
Yeah. For a portfolio manager, it is.
Yeah, I'm currently not far off you, 15 or so. Just been shaving off some profits and looking at it, almost exactly what you said earlier: high, medium, low. Done in a very similar way, just not as like all I'm looking at mainly is the highs, and looking at those like we've had 120% run on X, Y, and Z over the next few months. We should probably be taking a little bit off the table there, and just waiting for a little pullback on some of them.
And this is where I'm calling bullshit on Andrew Craig, and I'm a brave man to do it because he's the next chancellor. Of course, it matters if the market crashes.
Okay.
Of course, you're gonna be pissed off because you've just lost 30% of your money.
You haven't if you haven't sold it.
Oh, that's rubbish. Absolute rubbish that you haven't lost money if you haven't sold it. You whatever that P&L is, right? Whatever the figure is what your total is. Doesn't matter if you've sold it or not. If something happened and you had an accident abroad, you didn't have travel insurance, you needed to buy a new heart, and you needed 100 grand, then you got to sell it, and it's only worth that. The thing I would say that of course I see where Andrew's coming from, and it's a very lazy argument, and this is why he's an economist and an amazing writer, not a portfolio manager. If you've got 100 shares of something, right, and you sell it, and it goes down 30%, and while in the time that from when you sell it, it goes down 30%, you earn a bit of interest. How many shares can you buy back? If you rebuy, how many shares are you buying?
Okay, I see where you're going with this.
Like countdown, isn't it?
Yeah, but then
you've got 150.
Yeah.
If you earn 5% interest, you can buy 150 shares. So in Andrew's example, that you sell in 1987 or you sell in 1929, and you still buy every month. Okay, if you have taken a bit off the table, you can buy 50% more, which means by the time you retire, if you do it twice even, you've got double the amount of shares that you had to start with, and they finish at the same end point. Okay.
I agree with you wholeheartedly, hence why I moved some of my money into cash.
But
yes, because we're a different breed of investor to you extremely more than I am. I don't have the abilities or anything like that to do short-term trading. It's just not my thing.
No, but that's not short-term trading though, Sammy. That's what I want to get away.
No, I know that. I just want to finish this point because I think it's important. This is like, we spend time in the markets is what I'm trying to say. I'm not saying that that's short-term trading. The other side of it is Joe Blogs, mechanic, stick some money in your ISA, try and grow your wealth over the long term, never going to care about this stuff, but does care enough that his money's being inflation. What would you like? What are you saying to that guy?
That's why we're making the podcast.
Yeah.
Right. Because investing is for everybody.
Okay.
And this country's crap at teaching you at school. And so I was at an event at the London Stock Exchange last Wednesday to support financial literacy. And this is what we want to do. We want to take this podcast, The Art of Investing, and we want to get, teens and college and university students to listen to it and to learn, because every time we make a decision in that portfolio, we talk about it and we explain why we're doing it, right? But you don't even have to go that far. If you can see all the headlines that, we're in an AI bubble,
Yeah.
and you've doubled your money in something like Palantir in 6 months, understand that's not normal, right? And I'll give you another example. I'm a good boy. I go to church on Sundays, right? And you're looking at me with disbelief.
I don't know what's true anymore, Rich. Do you actually?
I do. I go to
Fair play.
church, HTB Church,
Nice.
in Brompton. And something really made me look, kind of sit up, literally. This week's sermon, Archie Coates, who's the local vicar, he brought up the price of gold in his sermon. And he said, some of you may have seen that the price of gold just went through 4,000. For me, that is it. Get the bell out and ring it, because you've just put a flag in the top of the market. If your taxi driver's talking about the price of gold, if your grandmother's talking about the price of gold, if the vicar in church sermon is talking about the price of gold, that is a short-term high.
Mm-hmm. I completely agree.
And it's the same with all the stocks. It's the same with the quantum, everything.
So your position on that is take a little bit more of a keen interest into what's happening and make decisions based on what you're seeing and how potential risk could be increased in certain places to essentially be able to buy more and be more active over the long term, which gives you that better decision.
Exactly. Because I tell you what is a great feeling when something sells off, and okay, you are losing a bit of money on the 70% of your positions you've kept, right? So that hurts a little bit. Mm-hmm. But my God, it feels good to see that cash and to go, I'm going to buy it again now.
Well, it's happened to me so many times. The biggest one I did was April after Liberation Day. And well, I actually waited 2 days after. It went down, and then it went down 5%. All my mates went in. I went, no, not yet. And then we had a chat actually. And then I waited again, and it went down 4% from there. And I was like, okay, today. And I just went. And I shut my eyes, and it was the biggest one I did. Every single time they'd gone down before, I'd slowly increased up a little bit more about what I put in. I potentially moved some money out of short-term savings and put that in there as well, because I'm like, it's never going to happen again.
Was it scary?
It's scary the day after.
Right.
And then after that, I actually just shut my phone, and then I didn't look. I just kept an eye on the news. I didn't even look at the stock prices. And then a few days later, I was like, that was the best decision I ever made. And I could tell it was just going to be the best decision I ever made. And it was. And so it was just about being a little bit more, it was kind of going against the grain of your own feelings. And because everything is telling you that's the wrong decision, but actually
right now, everything's telling you, Todd, don't sell.
Yeah, we're on a run.
This is easy. We're on a run. It keeps on going higher and higher. Why would I sell? That's the time to sell.
Yeah. There's certain things that I will just hold, and there's just certain things that I'll just never get rid of, and I'll just keep popping money in there. And that's like, it's just a rule. But I've moved from my 80-20 strategy, probably more of a 70-30, and now because some of my individuals have just been flying, and then I'm like, whoa, this is not normal. Like to be 200-300% up on some things, it's like that shouldn't be happening in 6 to 7 months.
And it's like that in the stocks, but it's also like it in the businesses. It's not normal for Nvidia to earn 80% margins on 95% market share. Mm-hmm. That will get competed away.
100%.
And it gets competed away means that the profits come down, means the valuation comes down, means that the share price comes down.
I want to ask you, because obviously Andrew is a friend of the podcast, and I want to make sure that we understand that there is that long-term time horizon is important. So I don't want to make everybody go that doesn't never work. And
no, I'm just joking. Yeah.
Of course, we know that, but some people may take that the wrong way, and so I just don't want them to because it's so hard to get them to even buy the index fund, which is such a big step anyway.
Agreed.
And so I want to get them to buy the index fund and then start doing low high each month, which for me is a brilliant next step for people. So if you're just buying your index fund, if it's gone up, this month, buy less. If it's gone down, buy more, and start doing that.
Brilliant. And that in itself, or just pausing 1 month.
Yeah, exactly. Yeah.
Yeah.
And if it's stagnated, you stagnate. Don't do anything.
Yeah.
You know, but still buy, but just don't buy as much. And
well, but you also don't need to be buying the same thing every month, right? Now, and this is again, I go back to the art of investing. We've got 12 assets, right? You don't have to keep on buying the S&P 500, right? It's been the best horse in the race, but this ain't horse racing, right? Just because Man United have been fantastic back in the 90s doesn't mean they're going to perform for the next 10 years.
No.
So they are alternatives.
Like if you are the guy that's just started doing something, don't stop doing it. Like still do something.
That's what I'm saying. Buying something different. Yeah. Buy the FTSE 100.
Yeah.
That's not financial advice. But FTSE 100's a lot more defensive.
Well, it's about balance, isn't it?
It's about balance, a diversified portfolio. Buying the S&P 500 is not a diversified portfolio anymore. It used to be.
No, it's not. Just have a look at the top 10.
Yeah.
The top 7.
The top 50%. Yeah. It's all AI.
Yeah, exactly. So you're buying almost a high risk fund. A good way around that is an equal weight, right? You can do an equal weight.
Now you're talking. S&P 500 equal weight is another option. Probably better than the Russell 2000, to be honest. Yeah.
Interesting. Okay.
Yeah.
Would you look at that as an example?
Oh, definitely.
Yeah.
Yeah. And that's the broadening out, because if you imagine, we know that AI is going to come into the pharmaceuticals. It's going to really help, podcasters, every single business going, right? AI is going to help. I saw an incredible photographer. Check this Playboy out, right? He hired out the whole of the Natural History Museum to propose to his girlfriend.
Oh, what a man.
I'm like, I said, take a bow, son. Take a bow.
Don't leave him.
So anyway, but the photographer was taking the pictures and managed. There was a few people when they came back to do the wedding photographs, and she managed to take them all out via AI. Anyway, sorry. So the AI stocks are where the investment is at the moment, but every single company is going to benefit from this. And so maybe the valuation breadth, the money starts going to the rest of the index, which means that you can benefit from the equal weight, which it basically means there's 1%, or less in each stock of the 500 stocks, rather than 34% of the index being in the top 10.
Yeah, which is nuts, right? And I think it's a nice way of looking at it. And you can do also, if you're not necessarily okay with tobacco and mining, you can do an ESG version of the S&P 500 equal weight as well. I know, but you can, and I get asked this question a lot, and so I like to bring it up.
Yeah,
but I tend to agree with you, so that's why I don't talk about it too much. But look, anything in particular right now? I'm sure you've got your eyes on the whole market. You guys are crazy how fast you move in the IG live show. It's great fun.
Thank you.
But anything you're particularly like, cool, I like that.
And I guess to touch on that as well at the moment. So nobody wants to watch, unless you're in the industry, nobody wants to watch CNBC or Bloomberg, because it's just a little bit dull and it covers a lot of politics and, European companies you're not interested in. I try and make Trade Live with IG a bit like Soccer Saturday. So
it's quite like that. Yeah.
Yeah. When the market open, it's like, and Rio Tinto's up 3%. What's going on there? And, one of my PCMs will tell us. So I try and make it fun. We have a bit of banter, and it's more of a podcasty kind of
it is
morning show.
It's kind of mixed between being on live, but then it's got that cool podcast feel to it. Like you do have those like real cool, and like you make trades live, and it's just good fun. It's just nice to watch. It's when I've got times I do have it on, but I often just put it on in the background.
Yeah, I think a lot of people do.
And if I'm on calls and stuff, I mute it and I put it in and I put it back on, because I like keeping my ear to the ground with you guys, and I think it's fun. And
the fun that also there's a community there, so it's on YouTube, so you can write comments and ask questions, and we answer them straight away. So that's pretty cool. why is British Telecom down 4% today? What are your top ideas? This morning we had Peter Hambro on. Now, Peter Hambro is the godfather of gold.
Very cool.
He had his own company and the Russians stole it from him.
Amazing.
So the guy's got incredible stories. And he brought in with him a gold coin, which was minted in the year that Jesus was born. How about that?
That's pretty cool. What
Pretty
I think you're going to
awesome.
be carrying around that around London.
And then he
these
went
days.
home on the Elizabeth line.
It's amazing what people, it just mind blows me what people do. But I would literally have armed guards around that thing in London.
But sorry, your question.
Anything you have got your eye on as maybe a sector or something that you're like, that's really interesting play. Maybe someone's not necessarily looking at that at the moment.
The problem is that you get so caught up in everything being so high at the moment that what hedge funds are trying to do is they're trying to find the parts that have been left behind. So anything good that's been left behind has already had money go into it. So now they start to buy the shit that's left behind and the really bad companies. And another red flag, the last one I'll give you, was that back in 2021, of course, we saw the meme stocks, the GameStops and the AMC cinemas. There was an ETF of all the meme stops. Of course, 2022, it got killed and it got delisted. It's just been relisted. That's another red flag to say we're back. And what are we back into?
Something orgy.
you just remembered that bit. The orgy of speculation.
Orgy of speculation.
That's right. So that was from 1929, October 1929. That was the phrase that the Chancellor of the UK government came out with to describe Wall Street, and it's actually what sowed the seed of the crash.
Okay. So we've had orgy of speculation and circle jerking. Is there any major ones that we're missing, Rich?
No, I think that'll probably do it after this podcast. Otherwise, I'll never get invited back.
Yeah, no, I love it, man. Look, it's always a pleasure to have you on. Don't let anything that we've said today scare you. Use it as knowledge, because these things can be scary when you have your money in the markets, etc.
But you should have done very, very well, right? There's not many things you could have bought that haven't had an incredible year. So give yourself a pat on the back.
I'm just worried about, we have listeners that may have started 2 months ago and ones that started 10 months ago and some that have been doing this for years. So I just want to make it very clear and just say, don't panic. Use this as a learning experience as well, because markets move in cycles for sure. Things will come back. It's just how long they take to come back. And so if you don't manage to do the right decisions on this time, watch, learn, and then take it on and use it in the next one.
Yeah, definitely. And don't have so much of your savings in there that it makes you feel uncomfortable. Start small.
100% agree with you there. Yeah. Emergency fund is the most pivotal thing in place. If you haven't got that in place and you're aggressively investing at the moment, stop what you're doing and start doing that, because that will stop you making emotional decisions if and when these things happen, which is just guaranteed, as we know. So agree with you, wholeheartedly.
Yeah. And be careful with crypto. Know what you are investing in, because if you invest in a company, you're investing in bricks and mortar. If you invest in crypto, you're investing in an idea. So that's something, and that was the head of London Stock Exchange that actually quoted that, Dame Julia Hoggart in her.
Oh, very quick last question. Cryptos and ISAs.
Yes, it's coming. Incredible. So,
wild.
Yeah, 21 Shares are actually going to have these crypto ETNs that you can buy in your ISA, and at last you can put Bitcoin in there without, having to go through a Bitcoin treasury company. So this is a big step forward.
What does that actually entail? Can you just?
Yeah, certainly. So the likes of 21 Shares is the safe one to do it with, because they actually have the crypto and they hold it.
Yeah.
And then they make equity, an ETN out of it. So it's like an ETF, right? So if you buy
that exchange traded note.
Exactly.
Right.
So the exchange traded note is backed by the real asset. And you can buy that just like you buy an ETF, and you can hold that. So you're holding Bitcoin or Ethereum. you're holding it in your ISA or SIP, just like you do with all your other assets. So you can have an S&P 500 and you can have Bitcoin at last. They can do it in the US. You couldn't do it here under the tax wrapper of an ISA or a SIP, and now you can.
Yeah, it's a big step for the UK retail investors as well. I think it's a good thing because a lot of people are interested in crypto and they get into just that. And so at least having it in a tax sheltered account is just a big step for the market for sure.
So I would imagine, I don't want to front run the guys in the art of investing, but I think we'll probably invest 5% of our money into that. So like I say, we've got 20% in American stocks, we'll have 5% in crypto, and then the rest spread throughout.
Do you come out the VanEck?
After a 51% rally, I want to. Because
it's a three-way portfolio. You got to.
It is.
All have buy-in.
And it's funny. Spice is the big bull. I'm the big bear, and then CJ's the chairman.
Okay, got it.
So it's quite. There's a lot of personality.
I'm going to tune in,
well.
and we'll 100% link to that. I hope you guys get some new listeners. I'm sure a lot of our listeners would find that valuable. So definitely hop over there. But Rich, always a pleasure, man. Thank you. We'll see you again soon. We predict another crazy episode where things have been happening in the markets.
When's 54 days from now? That's got to be almost
pretty in Christmas.
December
dude.
the 10th. Yeah.
Yeah, we may even be like coming up to Christmas period.
Yeah.
Oh, that could be juicy, couldn't it?
Right. December the 10th, down 25%. Let's go.
All right.
Sell everything.
Thanks, Rich. Pleasure to see you soon,
thank you.
man.
Cheers. And congratulations on a fantastic podcast.
Thank you.